Be ready. 5 seconds. I thank each of the honorable members who have spoken today fairly in detail about the insurance bill which opens up the sector to receive FDI up to 74%. Madam, as you are aware, insurance is a very highly regulated sector, and the regulator actually regulates many minute details of insurance itself. The regulator approves the product, the regulator regulates the pricing, the regulator oversees the investment, regulates it naturally, and also regulates the way it is marketed. So, insurance sector is very highly regulated. So, every bit of what we do after discussing in this house is part of what the regulators take into cognizance, and effectively that is what is point on point kept as oversight. All of us have been hearing discussions about FDI limit going up. Will it become another East India Company, and so on? I am sure many of us do recognize, and I would want to place it here for the record, that FDI is only an upper limit. There is no compulsion that every company will have to take up to 74%. Increasing does not mean the foreign investment will increase automatically to that extent in each one of the companies. And also, even as I go into the details of what are the safeguards, it will be very fairly clearly established that the policy holders' funds will be invested only within India, and that is not going to go out. So, FDI will not only bring capital, it will bring in greater competition, consumer will have more choice, there will be best practices being brought in from different parts of the world, know-how and technology on some long gestation activities which the insurance naturally implies will all have to be undertaken, and that will be possible with opening up. Madam Chairperson, I want to underline the fact that today there is 49% FDI allowed through automatic route, and that is since 2015. Many honorable members have questioned, saying what actually has been the benefit of that, what actually has been the penetration after 2015, has it made any difference? All private insurance companies meet insurance regulators' solvency margin norm of 150%. So, for every rupees 100, rupees 150 is got to be kept as cash or some kind of an asset. Today, many of the companies are hard pressed to maintain that solvency level. And when we talk about insurance companies, many of the times our discussions confine only to the public sector insurance companies, be they general insurance or life insurance. I will for a minute explain to honorable members that today the share of the public sector, whether it is in life insurance or in general insurance, and the share of the private sector will itself explain why there is a need for bringing more FDI into this country, because of the solvency ratio requirement. If you have to maintain it at 150% and you are in the private sector, if you have to raise equity for the business, it is not that easy. But at the same time, there are investors in the long-term funding nature, whether they are sovereign funds or pension funds, who are themselves wanting to invest in India so that they get enough returns. This will be important for the honorable members to recognize and to take cognizance. As I said, the attention of many of the honorable members speaking on this bill has been purely on the public sector undertakings. So, I want to underline this fact that 3 of the 7 public sector insurers are below solvency margin. But they are public sector undertakings, so the government will infuse money and they will be taken care of. But outside, in the private domain, there are companies on which the government has nothing to do, but the market will have to provide them opportunities to raise money, and that is why opening up and increasing to 74% is important. To presume that there is enough liquidity in the market today and to think there is no stress today may not be a well-founded argument. There is definitely a financial stress for raising money, especially for private sector insurance companies which need to maintain that solvency ratio. As I said, regulators require you to keep 150%. Where do they get that money from if they have to have that kind of solvency ratio as a matter of due diligence? Just for understanding, solvency margin is the ratio of assets to liabilities. I assure the honorable members that there has been enough thinking by the regulator. Since my July speech, where in my opening remarks I had said that there could be an increase in some of the sectors inclusive of insurance sector, that work was taken up by the regulator. Consultations were held, and it was clearly and repetitively said that we need to raise the insurance cap definitely because you need more money to come in. The consultations which the IRDAI has done included 60 insurers, a number of promoters, leading industry chambers, all of whom suggested that we need to increase it. So, it is only after due consultations that we have come up with this bill. Some of the honorable members were observing with a bit of anxiety that we are rushing through it, that we are bulldozing. There is none of that. There is a clear testing of the ground through the insurer, consultation through the insurer, and the opinions coming through from the industry's stakeholders, which affirm the need for increasing the cap, and therefore it has been taken up. So, the recommendations are very strong, and that is why we have gone ahead with raising the cap. Let us get a perspective of how many insurance companies are there in the public sector and in private sector. Otherwise, we tend to think that everything to do with raising of the insurance cap is only for LIC. This is not LIC bill.